Today we'll look at how you can pay off a mortgage with a whole life insurance policy. We'll look at an actual client that I've been working with since 2018, and we'll go over exactly how he plans to pay off his mortgage with his whole life insurance policies. And you'll see that if he follows this strategy, he's going to be able to accomplish the following. One, he's going to pay off his mortgage in about 3 years, where if he just keeps on paying his mortgage as is to the bank right now, it'll take him 26 years. Number two, he's going to save about $280,000 in interest with this strategy. And then number three, he's still going to have about $1 million in cash value when he retires, as a big part of these whole life insurance policies has been to build up the cash value so we can then use it during retirement. So we're going to take 3 steps in order to use his whole life insurance policies to pay off the mortgage. And this is meant to provide a guide really that anyone can follow when it comes to using a whole life insurance policy to pay off a mortgage. So we'll look at the 3 steps, then we'll look at his actual numbers. But first, let's provide a little bit of information on the mortgage and his life insurance policies. So on his mortgage, all of the details you're going to see are as of February 2025. He recently sent a mortgage statement, so we're going to go over the exact numbers. The current balance is $516,000 and change. It is a 30-year mortgage with an interest rate of 6.25%. His current monthly payment is $3,325, which comes out to just about $40,000 per year. Now, he's recently started to pay an extra $1,000 per month toward the principal. So if he doesn't do that, because the extra payments are optional, if he just pays the mortgage for the remaining 26 years, he's going to pay about $545,000 in interest to the bank, and that's just the interest from now until the mortgage ends. Meaning he's had this mortgage for about 3 years, and he's already paid the bank a lot of interest. So let's take a look at where we got that number from. His mortgage statement. So up top, you'll see the balance of $516,000 and change. There's the interest rate of 6.25%, and there's the monthly payment of $33.25. So here you've got the principal, then you've got the principal and interest amount, $33.25, and of that monthly payment, we can see how much is being applied toward the principal and how much is applied toward the interest. And then you'll see how much the balance goes down. So with mortgages, they're front-loaded, meaning we're primarily paying interest up front. So what we did with this, because this is about 8 pages long, and there's a lot of information here, is we put it on Excel. So let's take a look here. Here's what we've got. We've got the monthly breakdown we just looked at, line by line, all the way down about 365 lines or 324 lines. I was close. Okay, so that's a lot. I'm not going to scroll all the way down because that'll definitely bore you. What we did is just annualized it. So here's everything on a yearly basis. It's exactly what we just looked at on the PDF. What do you notice though about this sheet? The bottom. There are your total interest payments of $545,000 and change. That's a lot of interest to pay to the bank. And again, this does not include the interest he's already paid to the bank over the first 3 years. So his total interest is probably closer to $650,000 to $700,000 if he just pays on his mortgage like everyone else does, meaning just make the basic monthly payment. So details on his mortgage, check. Let's look at his whole life insurance policies. So he has 2 policies. The first is his policy that was started in 2018. He is currently funding $6,350 per year, and he has a current cash value of about $53,000. Then he has his wife's policy, which was also started in 2018. The funding, $10,600 per year. The cash value, almost $335,000 per year. Why hers is so high, by the way, is because during the early years, he aggressively funded the policy. He pumped a lot of extra money into it, specifically to beef up the cash value. So if we combine the values, because we're going to look at using both policies to pay off the mortgage, The yearly funding is $16,950, that's per year, and the cash value is almost $390,000. So we can see the values here if we look at some recent in-force illustrations. Here's his policy, highlighted in yellow. You've got the net cash value, $52,981. And if we look at her policy, there we go, $335 and change. I had $334 and change on the whiteboard. The reason why is because since I put this analysis together last week, he added a little bit more money into the policy. So that's why he's got a little bit more there, which is good. But very, very close. The numbers are their exact policy, I promise. All right, so let's continue on, shall we? We're going to go through the 3 steps. Step number 1 with this strategy is to increase the policy funding. Now, what we don't want to do is say, Jay, for this strategy to work, you need to put more money into the policy because that negatively impacts his lifestyle. Now he's got to put money into this product. He doesn't want to do that. So what we're going to do is just take money that's already going toward the mortgage and the policies and just find the best use of it. So we're going to take that extra payment of $1,000 per month or $12K per year and redirect it to funding the policy. So the combined values before paying anything extra in, we had yearly funding of about $17,000. Now we're going to take that extra $12,000 per year, which again are the extra mortgage payments, which gives us a total of just about $29,000 per year. And for the sake of making these numbers round, we're going to round up to $30,000 per year. Specifically, we'll look at $10,000 per year going into his and $20,000 per year going into her policy. They don't have to do that. The extra $1,000 is not going to impact his lifestyle or stress him out, so that's why we did that. But what we're going to do is fund the policy, each of the policies, only for 3 years until 2028. After 2028, there won't be any more payments. So let's take a look at the illustrations here. Let's start with his. What we've got is funding of what? For 2024, nothing, because he's already funded the policy. Then 2025, 2026, and 2027, there you go, $10,000 per year. Here's the cash value going to accumulate, and he's got his death benefit of $500,000 as well. Then we've got his wife's policy. Same thing, $20K per year. You will see $13,000 here. What this is there's a small loan on the policy right now, and we're just assuming she pays that off, which it doesn't have to be right now. It can really be any time between now and 2028, but that's a very small loan relative to the dollar amount that she's got in the policy. They'll be able to pay that off quickly. But we see the funding for another 3 years, and after that, nothing is paid again ever. So what we want to do to make this simple is lay everything side by side. So what we've got here is his policy, then her policy, and then the combined policy values. So now we can see they're paying $30K per year for 3 years. Here's the combined cash accumulation, and then here's the combined death benefit if they both pass. If just one of them pass, then we'll have to look at the death benefits on the left. And then on the far right, you've got the annual net yield, which cash value life insurance is what? Safe place to put money, continues to appreciate regardless of what's going on in the market or interest rate environment. Liquid, I can access it anytime I like. And then the big one, tax-free if I do everything right. So that was a big reason they were attracted to this, that safe, consistent growth along with the tax benefit. Sign me up. All right, so step 1 is to do what? Move more money into the policy, and really how we're doing that is primarily by redirecting that extra cash flow that was going toward the mortgage into the life insurance policy. Step 2, pay off the mortgage. What we're going to do here is in 2028, when we stop the policy payments altogether, is take a loan of about $500,000, because that will be the approximate balance in 2028, and pay the mortgage off in full. What's the benefit to this? Well, now you own your home free and clear. You could say that you're just transferring the debt from a mortgage to a life insurance policy. However, with a life insurance policy, there's no third-party crediting. It's a private contract. It's not reported on your credit score at all. You can even not pay the loan on the life insurance policy at all if you don't want to. My point is, you've got control and flexibility of paying it back, and it's off your credit report. You don't have to worry about making these payments to the bank and them collecting a boatload of interest over time. Does that make sense? So step one, direct more money to the policy. Step two, pay off the mortgage. Step three, repay the policy loan. And how we're going to do that is we're going to redirect money that was going toward the policy and the mortgage now toward the policy loan. Specifically, the policy funding of $30,000 per year, we're going to redirect that toward the policy loan. The mortgage payments of $40,000 per year, we're going to redirect that toward the policy loan. So that gives us a total loan payment of $70,000 per year, which is exactly what he's doing right now between funding money toward the policy and also the mortgage at about $40K per year, just with his mortgage payments as is. Make sense? All right, let's take a look at the numbers in action here. So we're going to look at our loan workbook, because this makes things much easier. But what we will start with are the policy values on the left. You'll see two death benefit columns. Death benefit, and then death benefit with loan. What's a major advantage to policy loans? When you borrow against the cash value of your life insurance policy, you keep earning dividends and interest on the full cash value, even though you've pulled money out. How the insurance company does that, one way they do that, is by collateralizing your death benefit dollar for dollar. So why we have that extra column is because when we take a loan, we're going to see that death benefit reduce. So let's take a look here. Firstly, we've got the mortgage. This will match what we looked at before. The first few years, by 2028, that balance is $492,000. Okay. So here, we're just going to make those monthly mortgage payments as is, which comes out to about $40,000 per year. And by 2028, the balance is what? $492,000. Now here, we can see of those payments, how much is going toward principal, how much is going toward interest, and then the total interest paid. And for 2025, if that looks low, we're in February at the time of shooting this video, so that's really just looking at 1 month of interest. That's why that looks so low there. But by 2028, we see how much are we paying in interest just to the bank? Almost $100,000, $97,000 and change. That's still a lot, but not nearly as much as it used to be. All right, so let's continue on here. 2029, the mortgage is gone. The reason why is because we're going to use a policy loan at that point in time. Now the cash flows, what I want to hit on here. The mortgage payment, why it's zero for 3 years is because it's being directed toward the mortgage. Why the policy payment is zero is because for 3 years, it's being directed toward the policy. Once the mortgage is paid off, now that mortgage payment frees up over here. So this represents cash flow that he now has that he can redirect elsewhere. At the same time, the policy payment of $30,000 frees up because we elected no longer to pay it toward the policy. That's why it's freed up over here. So now your total cash flow is about $70,000 per year. That is in 2029 after we've paid off the mortgage. Make sense? So let's look at actually paying off this mortgage. So what we've got here are the policy loan values. The interest rate on the policy is 6%. With a mortgage, the interest is front-loaded. With a life insurance policy, it's not. It accrues at simple interest. That's a big reason why we're going to be able to save so much in interest. So the maximum loan is going to match his cash value column over here on the left. And in 2028, we're going to pull $491,000 to pay off that mortgage. So the mortgage is gone, and now we have a fat policy loan. Okay. Here, you're going to see his loan payments. Here's your loan balance. Here's how much you're going to pay in interest to the insurance company every year. And this will tally up your total interest payments to the insurance company, just like what we looked at with the bank, with the total interest paid to them. So that cash flow of $70K per year, now we're going to redirect that toward the policy loan. So we're going to pay $70,000 per year toward the loan until it's paid off. Okay. There's your balance coming down. This $70K is going toward principal and interest, but you can see the interest is coming down quite quickly, a lot faster than it did with the mortgage. You pay 70 grand here, you see 27 goes toward interest and the rest goes toward principal. We're able to knock down this balance a lot faster than we can a mortgage balance. What do you notice about that total interest payments column? How much did you pay? Look at the bottom. Because here and the bottom are exactly the same. $166,000 and change in interest that he paid to the insurance company. He paid a total of how much interest to the bank with this strategy? $97,000 and change. You don't need a calculator to know that this is already working out beautifully for him. All right, so that represents the payoff. And at retirement, which he'll be right around 65 in 2043, there's his $1 million in cash value, combining the values of both policies, of course. So let's look at the results here. First, if he doesn't do anything and just makes ordinary mortgage payments to the bank, he's going to pay them $545,000 in loan interest over the next 26 years, not counting what he's already paid to them. There's the bank, there's you, if that's you in this situation. That's how I would feel at least. Now, if he elects to exercise this strategy, what happens? Well, the interest paid to the bank, when we just looked at our workbook, was $97,000 and change. The interest paid to the insurance company was $166,000 and change, which means the total interest he paid to both the bank and the insurance company was $263,000 and change. How much did he save in interest? $281,000. What makes this even sweeter and helps offset that cost a little bit is the fact that his cash value continues to appreciate when that loan is outstanding. Meaning when he takes the big policy loan of almost $500,000, he's still getting dividends on that $500,000 loan. So when he pays it back and then he retires, it's still worth that $1 million of value. So it does not impact his long-term strategy of being able to take income from this policy tax-free, because that's another benefit to cash value life insurance. You can take income on a tax-free basis if we do everything right and follow IRS rules. Now, with all of this said, there is a lot to this strategy. So what we always like to do whenever we're looking at long-term plans like this is just make sure we review it annually. We actually reach out to all of our clients every 6 months and offer a review meeting just to always keep in touch. But when we've got a strategy like this, we want to make sure that we're being proactive just in tracking the numbers, making sure we're sticking to the plan, because if we're not, we need to adjust it, which is going to adjust the overall numbers. In his situation, he is extremely disciplined. He looked at it and said, okay, I got it. I can pay everything off quicker. I like this. The only question he had was, this strategy assumes I just pay the mortgage off in a lump sum. What does it look like if I chunk it down instead? Would that actually help me pay the mortgage off sooner and save even more interest? The answer is yes, it would. It just requires a little bit more tracking, because if you're going to use the life insurance policy to chunk down the mortgage, now we've got to account for that loan interest and the mortgage interest, which if you're disciplined and okay with that, that works, but it does require a little bit more management. So I hope you enjoyed this one. I would love to hear any thoughts that you have in the comments below. You can also DM me if you'd like as well. If you'd like to see more case studies like this or strategies around how you can use a whole life insurance policy to pay off debt, whether it be mortgages, commercial real estate, student loans, car loans, whatever it might be, you can check out our website, as we've got several case studies and videos that go through exactly what our clients have done. So I hope you enjoyed, and as always, I hope this helps.